Hey everyone, in this video I'm going to do an interesting comparison. Palo Alto Network stock compared to Snowflake stock, the cybersecurity stock versus the data company. Two different industries that each have strong tailwinds pushing them upward, propelling them upward. Cybersecurity, of course, you all know, the more we spend our lives online and on computers and on electronic devices, cybersecurity is becoming more and more of a necessity. Data, of course, data is becoming even more popularized now that it's become the foundation for the development of artificial intelligence models. So both have strong trends propelling them forward. But which one is the better stock to buy? That's going to be interesting. Let's dig into the details and let's figure out that question.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing I'm going to compare these two on is revenue, and they've both been growing revenue nicely, although Palo Alto Networks has been growing relatively faster than Snowflake and is roughly 3 times as large in terms of total revenue. Trailing 12-month revenue came in at 7.5 billion for Palo Alto Networks, while it came in at 2.8 billion for Snowflake. Over the next few quarters, they both face some headwinds. Palo Alto Networks took an interesting strategic approach in its latest quarterly update to investors, stating that they're going to go after taking market share, and they're going to do that by offering free trials to customers who have other providers so that they can consolidate to Palo Alto Networks. They want customers to have all of Palo Alto Networks offerings and not just one or two of their services. They want clients to go to Palo Alto Networks for everything. And to do that, they feel they need to give everyone a free trial so that if they have contracts with other providers, they won't have to pay for two different providers at the same time. They think that's going to be successful in gaining market share. Remains to be seen if that's true. Snowflake, meanwhile, yes, it's true that AI models require more data, but at the same time, companies are being selective and more selective about the data they're keeping. Data collection and data storage is becoming more and more expensive, and companies are looking at it and saying, is it worth it for us to keep 7 years of data? Or should we just eliminate the most past 2 years of that 7 year data? So let's eliminate the last 2 years and let's keep just the 5 most recent years of data. And so let's reduce our amount of data. That way we won't have to pay as much for data storage and data upkeep and data protection and all of that, right? So that's a little bit of a near-term headwind for Snowflake as well, even though longer term the company has excellent growth prospects as well. The next thing I wanted to compare these two on is their shareholder dilution, how many shares outstanding they have. And looking at this metric, you can see Palo Alto Networks in recent years is diluting shareholders more so than Snowflake, although they're both guilty of diluting shareholders. Palo Alto is doing it more so than Snowflake. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. One of the reasons why they're diluting shareholders so significantly is because they each pay significant sums in stock-based compensation. That allows these companies to generate strong cash flow from operations, while at the same time being not so profitable on the bottom line. Their cash flow from operations to sales ratios are way stronger than their operating profitability. Palo Alto Networks more so than Snowflake at 40.68%, but Snowflake is demonstrating the better growth in this metric. As you can see, the trend line, the slope of increase is much more pronounced for Snowflake than it is for Palo Alto Networks, even though Palo Alto Networks has a better margin here at 40 compared to 30. Looking ahead for the next 5 years, the analysts on Wall Street that are following Snowflake stock expect it to increase its earnings per share by 18.05% for the next 5 years. Interestingly enough, the analysts on Wall Street that are following Palo Alto Network stock expect it to deliver 17.83% increase in earnings per share per year for the next 5 years. So they have very similar growth rates expectations for earnings per share for the next 5 years. Now, I want to compare these two on valuation, and I want you to understand why the forward price to earnings ratio is so important. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you've got an understanding of why I'm choosing the forward PE ratio, you can see that Snowflake is more than twice as expensive, almost 3 times as expensive as Palo Alto Networks. Snowflake is trading at a forward PE of 118, a really expensive valuation. While Palo Alto Networks is not cheap by any stretch of the imagination, but when you compare it to Snowflake, it looks cheap because it's only a fraction of Snowflake's valuation. Palo Alto Networks trading at a forward PE of 45.53. So other than the rate of increase in cash flow from operations and the more significant shareholder dilution from Palo Alto Networks, I haven't seen very much that signals Snowflake deserves this much of a premium valuation over Palo Alto Networks. So if I was considering these two growth stocks, then Palo Alto Networks would be the stock I would choose today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.